screens. It will show up here, and we'll take them in order and try and get to them all in the space of the full webinar. First thing I'd like to make sure we go over is a little bit of the logistics of the webinar itself. There's two options for audio. We probably have figured them out right now. One is with a mic and speakers with if you're using VoIP. Another one is using the telephone, and the dial-in numbers are there for Canada and the United States. In addition, you can submit your text questions through the questions panel, and we will endeavor to answer them all as we go along. A copy of the presentation can be downloaded through the site. If you have any issues or concerns, you can also send us a note separately if you wish, and we can try and solve any concerns you might have. The Canadian Energy Research Institute has been around since 1975. The organization is independent, it's a registered charity, and it conducts research related to the economic and environmental impacts associated with our energy sector. We conduct research looking at oil, gas, and electricity activities. In this case, our focus for today is on oil and gas. Okay, so we have three core funders. As I mentioned, we're a charitable organization. We have three core funders: the Alberta Government, Natural Resources Canada, and the Canadian Association of Petroleum Producers. In addition to those, we have other organizations including Alberta Industrial Heartland, Canadian Energy Pipeline Association, Chemistry Industry Association of Canada, governments of BC and Saskatchewan, Canada First Research Excellence Fund, which is a University of Calgary endeavor, and the Ivy Foundation. So I'm going to take you through the work we've done looking at the future of oil and gas, give you some production outlooks, supply costs, information about emissions, and of course economic impacts, and a little bit in terms of what the future might hold, in particular for bitumen. So we've seen some recent challenges in the Canadian oil and gas industry. The main issue, of course, is lack of market access because of insufficient pipelines for the oil market. In terms of market access as it is connected to the natural gas industry, it's much more an issue of the US market having enough domestic production to start to push out Canadian production. And that won't be solved by additional pipelines. So Canada in its future needs to look at alternative markets for our natural gas. There are some ongoing regulatory and judicial processes for Enbridge's Line 3, the Trans Mountain, and the Keystone XL pipelines. All three of those are moving forward, slowly, but moving forward. The TMX construction has commenced, and we will see what is the install date for these projects as they move forward. The only one that is close to confirmation is the Enbridge Line 3, which should be operational by the end of 2020. We've also seen significant differentials between Western Canadian Select and WTI, reaching upwards of $30 a barrel. We've seen depressed AECO gas prices for producers, and that's primarily because of the higher competition from US producers. We've seen some significant changes in the regulatory process. We have the Impact Assessment Agency of Canada and the Canadian Energy Regulator up and running now. And just to jog your memory, these are the organizations that were brought forward as part of the Bill C-69 legislation. So these two organizations are now fully functional, and the CER is the current incarnation of what was the National Energy Board. In terms of that, there's some interesting work going on. There are 3 projects going through the current process related to the Impact Assessment Agency. Actually, it's 2 projects. One is the Gazoduc natural gas pipeline in Quebec that's supposed to connect to a LNG facility on Quebec's Atlantic coast in the St. Lawrence, and the Cedar LNG project in Western Canada. We're coming up on January 1st, which means that the new sulfur regulations for the shipping industry come into effect. And CERI has done some work on that, suggesting that there's going to be a significant impact on the differential as a result of the high sulfur oils that Canada produces. And we've also seen depressed service industry due to reduced drilling, and the recent reports coming out from the Services Association as well as the Oil Well Drillers Association identifies that this is going to be a low period going forward for drilling activity. However, we do see some bright sides. We see oil and natural gas production keeps growing. In the case of oil, we're looking at an 8.5% increase from in 1 year, 2017-2018, and a 4% for gas, 2017-2018. And that's due to additional use of oil by rail and the change to TransCanada or TC Energy's pipeline tolls on the main line. We've also seen growth in Canadian oil going into the US markets, particularly the heavy oil, the oil sands, and that is because of the substitution that the US is making away from oil from Venezuela towards Canadian products. FID has taken place for LNG Canada, and they're under construction, and they're also talking about expansion. We see the Bay du Nord project off the coast of Newfoundland, and that's got 300 million barrels reserve. That's moving forward. In addition to that, the Newfoundland government has a very ambitious policy to reach 600,000 barrels per day of production by 2030. Which would be almost double of what they're producing now. New propane facilities have been put in place. AltaGas is located in Prince Rupert. Pembina is close to a final decision. And we see the 2 propane petrochemical units come in. We've got interpipelines under construction, and Pembina is close to an FID. And finally, we've seen the Western Canadian Select and WTI come back to normal levels due to the curtailment of oil production by the Alberta government. So there's a lot of talk, and if you look at slide 9, there's a lot of talk in terms of the global market supply and demand, and a lot of people are saying there's peak oil will be here soon, and that the world is going to move away from oil. And the one thing that I would caution is, if you look at all the forecasts that we see in this for the future of oil and gas, in particular oil, we don't see any significant reduction in the overall demand. In fact, the demand is actually incrementally increasing each year at a higher level. So where we saw in the past demand was increasing around 1 million barrels a day per year, now it's more in the range of 1.5 1.4 to 1.5 million barrels a day per year. So that doesn't suggest that the overall demand for oil is changing anytime soon. Recent IEA report has oil demand peaking by 2030 in 2 of its 4 scenarios. In the other 2 scenarios, it has the oil demand continues to increase. Even in those scenarios where oil demand decreases, we still see a significant demand for oil for the foreseeable future. This just shows you where the industry has gone in terms of Canadian crude oil production over the last 10 years. You can see a couple of things related to this. One is that the majority of oil production is associated with the Alberta bitumen and synthetic crude oil, and also that the overall production for this sector continues to grow. Going back to the point I raised about the increase in Canadian exports to the US, we see that growing at a 7% rate historically, or at least in the last year. And that is dominated again by heavy sour crude, which is mainly coming from the oil sands. You can see here in terms of slide 12, the growing Canadian share in US markets is really the story of what's happened with Venezuela. And you can see that Venezuela's percentage has dropped from a high of around 40% to a low of 33. And that is the parallel of what we see with Canadian imports into the United States. So for Canada, that means there is an opportunity to develop and lock in additional relationships with the US market, in particular in the US Gulf Coast, while Venezuela is in a struggling position. Once Venezuela is able to fix its domestic policy and move towards additional investment in its oil sector, it will likely be very aggressive in trying to gain back the markets that it lost. So this is an opportunity for Canadian oil companies to get their product to market, especially in the US Gulf Coast, and lock in those relationships for a period of time. On the gas side, what we've seen is significant growth, or at least some growth in overall demand for gas in Canada, and it's increased by 4% from 2017 to 2018. We're also seeing significant imports from the United States, mostly into central Canada. And what that leaves us with is a shrinking market for Canadian gas in central Canada and also into the United States. So as I go forward with this, one of the points I'll be raising is Canada needs to find new markets to sustain and possibly grow its natural gas industry. This is just a current snapshot of where gas is right now. Again, Alberta has the majority share of activities associated with gas as it does with oil. BC has got 30%, Saskatchewan, and then Nova Scotia with a small amount. In fact, that Nova Scotia number will probably get to 0 fairly quickly because the Deep Panuke basin has been decommissioned. It's being decommissioned right now. We also see some changes, though. We've got hydraulic fracturing bans in Quebec and Nova Scotia, and both are continuing to have a review of those activities, but there's nothing to suggest that those bans are going to be removed anytime soon. What's interesting, though, is that there's a partial lifting of the hydraulic ban in New Brunswick, centered around its specific basin by the Bay of Fundy. And we shall see how that works in terms of the potential for new isolated areas of removing this ban in different jurisdictions aside from New Brunswick. Okay, so Canadian oil sands. This is our forecast for Canadian oil sands, and you can see it is robust, and this is a reduction from forecasts that we've done in the past. However, what it does indicate that is that there is potential for this industry to grow significantly from where it is in 2019 towards 2039. We actually don't see a peak in the local market for oil sands for a variety of reasons, one of which is the falling costs and improving environmental footprint, and we'll get to that in a bit. This next slide shows that we're in a fairly stable situation right now for crude oil, conventional crude oil. Here also take note that we've identified condensate in this chart. So if you remove the two top bands, then you'll see the conventional crude oil numbers. Fairly stable over the long term. I wanted to add in the Newfoundland and Labrador production forecast to show you how the Bay du Nord project is going to be accretive to its overall production. And as I mentioned before, the province has a policy that they're looking to increase production to 600,000 barrels by 2030. That will depend a lot on how successful the drilling programs are that the companies are undertaking right now. But there's definitely a lot of interest from foreign investment and major oil companies to look at the offshore and continue developing that. So when we add up everything together, and this is just the entire oil production forecast from coast to coast, we're looking at roughly a production level right now of about 4 million barrels per day, going up to about 6.5 million barrels per day by the end of the forecast period. There would have to be a significant change to the market for this not to come to pass. There's still a significant demand for oil, and it, in our view, will be still strong even out to 2039. I wanted to provide this slide because it has this is a Canadian oil supply and pipelines. So what we've done is we've superimposed the three major pipelines that are actively being considered and worked on, and looking at the need. And you can see clearly that the production levels, because we have historic production as well as the forecast in here, the production levels are higher than the maximum capacity of the existing system. With the addition of the Enbridge Line 3, Kinder Morgan, and the Keystone XL, we will get to a position where those three pipelines will be able to meet the need. The gap that we see on the chart between the Keystone XL dotted line and the top of the production is not really a significant amount. And of course, we've assumed certain in-service dates for these projects, which may get pushed back for various reasons. What that means is these three pipelines in and of themselves will be sufficient to manage the existing growth, but after about 2030, something else will have to be put in place. Now, another point to keep in mind, though, is there are some optimization projects going on within the entire takeaway infrastructure, and those are expected to increase capacity from about 350,000 barrels to 500,000 barrels a day. And that incremental improvement is not part of this chart. These are 3 new or refurbished pipelines, but the optimization projects are not included in this chart. Canadian natural gas production is going to be dependent on LNG markets. And we see here in our analysis, we've made assumptions about the equivalent of 5 to 6 BCF of gas demand from LNG. Now, as we know, the LNG Canada project could get up to about 4 to 5 BCF a day. So additional projects would need to be built in order to fulfill on this production forecast. The one thing to keep in mind in terms of the expansion of LNG is that it is very cost effective in Canada, in particular because of our low gas prices. And so assuming that the regulatory processes can be as efficient as possible and we have international investment in new projects, this could be relatively easy to achieve, this additional demand from LNG, and that would therefore support an increased price at the ACOC hub. Part of the good news that's in our analysis of the oil and gas market is the fact that the price of or the cost of production is going down. And if you look at the bitumen supply costs on slide 21, you can see that the costs are in a very low range. And what we're indicating here is that in both new and expansion SAGD, that's steam-assisted gravity drainage systems, they are actually cost-effective right now, given the price that they can achieve. Even with greenfields projects, which is the larger number shown at $40.61, it is cost-effective. The real question is not whether or not bitumen is cost-effective; it's whether you can get it to market. And it comes back to the market access. So supply costs are not the issue for the industry when it comes to enhancing the overall sector's ability to produce more more bitumen. In addition, when we looked at the conventional supply costs, we focused on the Western Canadian Basin, of course, here. And what we're showing is, if you focus on the gray numbers, which are the horizontal drilling, you can see that all those costs are within the realm of competitiveness in our current pricing environment. On the gas side, it's a little bit of a mixed story. If you had followed the market, the AECO market over the summer, you would have seen prices in the 25 to 50 cent range, which is not achievable by the producers in Western Canada, and there was a significant concern around that. The price has since increased and we're above $2, and it makes the majority of the projects or basins in Western Canada cost competitive. Now, you'll recall that the previous Alberta government put in a emissions cap related to oil sands activities, and the cap was set at 100 million tons per year. What we show on this graph is the emissions associated with oil sands activities out to the forecast period. And there are two lines there, and I want to really address those two lines because it has some policy implications. The first line, the larger line, includes activities such as cogeneration, and so feeding into the energy requirements of the oil sands production activities. The bottom line does not include the emissions from cogeneration. What you see, though, is that the top line is based on the emissions intensities as calculated by Environment Canada and Climate Change. And the lower line relates to how the Alberta government calculates those numbers. So if we were to say that the 100 megaton cap is here to stay, calculating the emissions one way has the industry staying underneath the cap as a result of improvements in processes, and even while they're growing in volumes. But if you look at it from the federal government's perspective, we will have crossed that line of 100 megatons by 2020. So that is a policy area for the Alberta government and the federal government to have a discussion on if that 100 megaton cap is to be maintained. CO2 emissions from conventional oil are fairly straightforward. They've been in the 30 million ton range for, or will be for an extended period of time. Those industries, their main focus at this point is on trying to minimize these emissions while maintaining a competitive price for their commodities. In terms of gas production, we see that the emissions with and without methane reduction are clearly shown. Without methane reduction being included in that analysis, the emissions are in the 50 million ton range to the end of the forecast period. You can see it coming down until 2025. And that's because of the loss in either the export market into the United States or in the loss of the market into central Canada. However, if you look at the overall costs or overall emissions, including methane, they're much higher, reach up to 70 million tons per year. There are regulations in place to improve those emissions. And CERI has actually done a study looking at what the cost would be associated with those. And you can find that study on our website at ceri.ca. There is a lot of investment in Canada's oil and gas sector. If you look at this slide, the economic impacts, you're looking at conventional and oil sands investments over a 10-year period. Recall that the forecast is over a 20-year period, but we just limited our capital investment analysis to a 10-year period. On the one hand, you've got the investments in the range of $160,000 million, so it's $160 billion over that 10-year period, and for Alberta, and much smaller amounts for the other provinces. So the oil market is really an Alberta story. There's a little bit in BC, Saskatchewan, Manitoba, and Newfoundland and Labrador, but really the lion's share of those oil activities and oil investments continues to be in Alberta. In terms of natural gas, you can see here that Alberta remains a very large component of generating operating revenue of $40 billion over the time period. You can, sorry, that's the capital investment. but you can see here that British Columbia is increasing its capital investment significantly, and that is reflective of the LNG projects that are underway. Looking at the GDP impacts associated with the oil and gas activities, we note that there's a significant amount of give back to Canada as a result of these activities. And you again will see that the lion's share of those impacts is associated with the Alberta oil sands. It's more than double what all the rest of the activities in Alberta, Saskatchewan, British Columbia, Manitoba, Newfoundland, and Labrador. It's much larger than those together. Those are increasing over time because the production forecasts are increasing over time. We're looking at $100 million investment or GDP impact in 2019, and that's going up and up and up, upwards to $160 billion in 2029. On the gas side, the gas GDP impacts are much smaller, and you can see here that it's a little bit more evenly split going forward. Again, it's because the natural gas for LNG is going to be taken significantly from British Columbia and not from Alberta. At least that's the assumption that we're making. That might change once we get to a point where they're operating. But we're looking at 10 million contribution in 2019, going up to 30 billion contribution in 2029. Employment continues to grow over the forecast period on the oil side. Now, one of the points that we have raised is how the types of jobs may be changing given the new investments in artificial intelligence and machine learning. We could be seeing a change from a lot of people working in the field to a lot of people working in an office. So that trend is one thing that we're paying attention to. But on an overall basis, you're looking at anywhere from 400,000 in 2019 to almost 600,000 in 2029 of people working either directly or indirectly for the oil sector. Natural gas is also a big generator of employment in Canada, 60,000 in 2019, going up to 160,000 in 2029. Again, those impacts in the latter part of the period are due to the associated effect of the LNG projects. Now, all what I've talked about so far has been about taking oil and gas out of the ground and burning it. What I wanted to do was to talk a little bit about bitumen beyond combustion. And the bitumen reservoir, or reservoirs, I should say, in Western Canada have very unique properties. And we are the largest deposit of bitumen in the world. There are other countries that do have some, Kazakhstan, Russia, and Venezuela. And the uniqueness of this asset allows for other products to be made out of the same process where people are extracting crude oil out of the bitumen. And I've identified the three there. One is asphalt for roads. And a study that we reviewed, we didn't conduct this study, identified that if you were looking at the 2030 target For the demand for bitumen for asphalt, that would be about 3.6 million barrels per day. We haven't included any of those additional opportunities in our forecast. So this is 3.6 million barrels per day of additional demand for bitumen, assuming a 100% market share by 2030. So even if we were to see a reduction in terms of the transportation market where it's combusting, we see growth in the non-combustion products that bitumen can provide. Asphalt is one, carbon fiber is another. And in fact, the demand for carbon fiber will only grow because of the new construction techniques to reinforce cement or concrete with this carbon fiber instead of rebar. And the construction industry is a very large sector globally with a lot of cement and concrete being used. And as a result, this carbon fiber can have a quite robust market demand. And in this case, by 2030, if the market was to evolve, we're looking at an additional 6.7 million barrels per day. Keep in mind, right now, just in total, Canada is producing about 4 million barrels per day. And so this would be a significant boost for the Canadian oil industry. Vanadium for batteries, that one is a little bit more of an uncertainty, but it's still a possibility. And that would include a demand for 7 million barrels per day of bitumen. Finally, I'd just like to conclude with a few points that I raised during the talk. The first is that we see a growth in oil and gas production, but that is predicated on growth in exports. Some have indicated that, well, if we move away from coal-fired generation in Canada, we would see a significant increase in the demand for natural gas for the electricity market. And that's just not proving to be realistic because we could see an increased demand of maybe 1 or 2 BCF a day, billion cubic feet a day, but really not enough to overcome the loss of the market into central Canada or into the United States. So when we're talking about growth in exports for natural gas, we are talking about LNG. Cost of crude oil, bitumen, and natural gas remain competitive. In fact, they've all been coming down of late because of the advancements the industry has been doing and the investments they've been making in terms of innovation and new technologies. The point about market access cannot be stressed enough. The crude market is financially or economically competitive. It's got a significant improvement in its environmental footprint, which continues to grow, continues to get better. But without market access for the crude, you won't get the production forecast that we've indicated. It just won't happen. You might get a few 100,000 additional barrels that could go on to rail. And of course, you could get the optimization projects coming on, which could bring you 300 to 500,000 barrels a day. But if this market is to grow, if that is the direction of the government and industry that it is to grow, then all three of these pipelines that are being discussed are required. I wanted to also note that the decarbonization of the electricity grid in Western Canada will help reduce emissions of oil sands production. And I noted that in terms of where the industry is getting its electricity through natural gas cogeneration, the federal government is including that in their overall emissions cap or the overall emissions forecast, and the Alberta government is not. So that will decarbonize the oil sands production depending on who you talk to. So that's a policy question that needs to be identified. Optionality I mentioned for bitumen beyond combustion. The natural gas market is always going to be a strong element for the petrochemical growth. So we see some significant increase in demand for oil and gas from Canada. However, and this is one point I wanted to add at the end, and I don't have the answers to this, there is a market risk. The US and China, as everyone knows, is facing a trade war between those two countries, and they are talking about a trade agreement. And the real question is whether or not oil and gas will be part of that trade agreement. Right now, there is a delay in some of the natural LNG shipments out of the US Gulf Coast to China because of the trade war. But if this was to be, if an agreement was to be reached, will the US become a preferred supplier to China? That's a big question. And if they are, both in terms of oil and gas, where does that leave Canada? That's a significant unknown, and I'm not sure when we will find out one way or the other what happens with respect to that that agreement. So I'm finished the presentation. This is the time where we can ask questions, and if you have a question, please type them in to the question box on your screen, and they'll pop up here, and we will endeavor to take them one at a time. I don't have any questions showing up as of yet, so we'll wait. No questions? One point I just like to reiterate in terms of the pipelines, as I mentioned before, our assumptions around the pipelines are an integral part of our assumptions around the future of oil production in Western Canada. Keep in mind that the Newfoundland offshore doesn't require any further market access, but Western Canada does. I have a question here, do the employment figures consist of direct only, or is it indirect, or is it direct, indirect, and induced? It is direct and indirect. We don't include induced labor impacts anymore. There's a lot of concern around whether or not those impacts are reasonable, given that the induced market is not a secondary effect after the direct market, but a tertiary effect after the market activities filter into the economy. And it's also very difficult to say whether or not one job in a restaurant is associated with oil and gas activity versus forestry versus other retail. Do the projections in demand factor in the impacts of the IMO regulations? No. In our previous study on the IMO regulations, we said the cost implications could be in the range of $20. $20 in addition to the discount we see right now, or the historical discount, which has been between about $10 and $13. So if that was to come in place, our numbers suggest that that differential will increase to $30. That puts about half a million barrels of oil in a non-competitive price point. But there's a lot of ifs associated with that. We tried to add a lot of caveats in our analysis because it's going to depend on how the refineries react, if they retool and will continue to take on the high sulfur heavy oils from Western Canada. And it also depends on how the marine industry actually adapts. In the case of North America and Europe, there's already a much more stringent sulfur regulation in place of 0.1%. And the international regulation is going to go down to 0.5% from 3.5%. So there's a significant part of the market that's already moved past that point. So the real question is, what happens to the rest of the market, and how are the refineries going to react? But it doesn't, our forecast doesn't include impacts associated with those regulations. Have you factored Eastern Canadian LNG projects into your natural gas forecast? In our natural gas forecast, we just assumed for a higher level of LNG, period. And what we've done is just say that there's going to be 5 BCF of demand somewhere. And where is that gas coming from? Some of it's coming from Alberta, some of it's coming from BC. We see a smaller amount coming from Alberta because the larger facilities are in BC. So we haven't been specific about whether or not the LNG projects are going to be East Coast or West Coast, with the exception of LNG Canada. Next question, is there a realistic scenario where AECO rises because gas production falls with LNG export rise? If so, where do you expect AECO prices to achieve? Well, if I knew how to crystal ball the market, I wouldn't be doing this. But there is, I would look at the LNG market as being able to stabilize the AECO price. We've just gone through a significant decline in the AECO prices over the summer. They've come back, as everyone would expect, because it's winter and people need the natural gas for heating and for additional electricity generation for electric heating. So I would see the AECO prices being firmed up by LNG exports. And given that, I would look at what would be the historic level, so somewhere in the $1.50 to $2.50 range, depending on how the rest of the market is working in the United States. One of the issues right now we're seeing in the United States is the Marcellus Basin is facing pushback in terms of its gathering systems, and local citizens are not wanting to expand much further. So if that was the case, then we could see that Western Canadian gas producers could be going into central Canada for much longer than we had anticipated. Are there forecast increases in global market demand based on your own global model or IEA scenarios or some other? We take a look at both the IEA scenarios and the EIA scenarios as well. And over the forecast period, the majority of those show increased growth. So all we've actually identified is the expectation for continued growth based on announced and planned projects in Canada. And you also see that the conventional oil forecast is fairly flat. How do Canadian climate policies impact the forecasts? Well, what we've identified, or what we're assuming, is that the industry and the governments will reach some sort of agreement where continued growth will occur while the industry or others are investing in ways to reduce emissions. Canadian oil industry and the natural gas industry have been very good over the last 10 or so years, reducing their emissions impacts, and we don't see any reason why the climate policies of Canada would impact those markets going forward, given the fact that we see actually now support for all 3 of the pipelines coming from the federal government. They may be not as robust commitments as people would like, but they are there. And all three of those pipelines are moving forward. Trans Mountain's moving forward, Keystone XL is moving forward, Line 3 is moving forward. It's, in our view, it's a matter of when they get developed, not if. There's been significant natural gas pipeline expansion in Nova and other gathering systems. Do you expect LNG exports to be from expanded BC production and Alberta production to flow through Nova to long-haul pipelines exports such as TC and Alliance? We didn't really look to that level of significance in terms of flowing through the Nova system to long-haul pipelines, but it would definitely be part of the overall scenario, and the expanded BC production would be probably the largest portion of the market that would be linked to LNG requirements. What's your best guess as how Alberta and the federal government resolve their differences on the emissions calculations, timelines? This difference in terms of the calculations has actually just come up because we've found it looking at our own analysis. So we've talked to some of the folks in the federal government about the emissions calculations, and they're just having their internal discussions now. I do not know when that they would come to a resolution on this. I think there's going to have to be a lot more discussion. I don't think it's going to be anytime soon, but it actually might be something that the new Canadian Centre for Energy Information could deal with as it's developing its set of data indicators for the energy sector. But as to when that's going to happen, I have no idea. Next, what do you think of the future of oil refining in Canada, specifically in Newfoundland? Well, you know, I'm a proud Newfoundlander. I remember driving by the Come By Chance refinery when it was locked up for the second or third time. I wouldn't put money on it. There's other places that the oil can be refined, and once it gets on board ship, it can go anywhere in the world. I would look at the Newfoundland refining to be for domestic markets in the province and also in Atlantic Canada. Is there a future? I think there is. I think that if we're looking at the expansion of some of the demand in terms of transportation right now, especially in Eastern Canada and Western Canada, I can only see additional oil refining capacity needing to be built. One interesting thing is about oil refining that we haven't talked about too much nationally is upgrading. Upgrading the heavy, in particular the bitumen in Western Canada, would be a solution for the lack of capacity on the pipeline. Because you keep in mind that the diluent that goes into the pipe with the bitumen takes up about 30% of that space. So if you're able to do some upgrading in Alberta before you put the oil into the pipeline, you could free up 30% of that space very quickly. We haven't done any analysis looking at the cost effectiveness of oil refining, but that would be an interesting question. How do you factor access to capital or lack thereof into your production projections? One of the things that we've noted in terms of the market is when you have an asset that's up for sale, especially in Western Canada, you always have a buyer. I mean, there's been some projects that have gone at reduced asset values, but others have not. So as long as there's buyers, we see interest. That interest is tempered by the concern with market access. So if market access comes and the additional exploration comes with it, I would see that access to capital will return. Right now it is difficult. Right now it is people's balance sheets are not as good as some of the financial institutions would like, which is one of the reasons why the companies are cutting back on drilling programs and trying to create a more robust balance sheet. What is the methodological basis of the difference between the feds and Alberta on calculated emissions? Well, one primary one is that cogeneration is included in the federal government's program, and they've taken some average numbers to project the entire industry going forward, whereas we've taken the more advanced numbers for the future growth. So those are the two main issues with respect to the difference between how the federal government and the Alberta government are calculating those emissions. At some point, some reconciliation needs to be made, especially if that 100 megaton cap is to stay in place. Can growth occur for conventional oil and gas in the Western Canadian Sedimentary Basin? Yes, it can. The costs are reasonable. It just doesn't seem to be where the industry is putting its efforts these days, especially in conventional oil. Most of the activities on the unconventional side at this point. For gas is going to be driven by demand, pure and simple, and local demand. And when I mean local demand, I'm talking about LNG projects and the possibility of methane-based petrochemical facilities being built in Western Canada. We actually did an analysis a year ago looking at the return on investment of methane-based chemistry, and several of the processes were cost effective and had an internal rate of return of 16 to 18%. So I see a lot more potential upswing on the gas side in Western Canada than the conventional oil. But in terms of conventional oil, we still see that as a solid contributor over the longer period of time. How much of your Alberta gas production forecast is from associated gas versus directed drilling? Well, that's a good one. You've got me stumped there, John. I will have to get back to you on that. I know that there's a fair amount of associated gas, but I don't have a specific percentage that I can give you right now. But we can send a note to you and the other participants, and I'll get you that number, but you've stumped me. We don't have any other questions now, but I think okay. Oh, here's we got. Oh, thank you. Thanks, John. John writes, thank you, great presentation. I did not mean to stump you, but you did. That's okay. I don't know everything, and it's good to be told that every once in a while. If there are no other questions, we'll close off. I will give people a couple minutes, and then I will formally close the session. I wanted to just note, as you're thinking about potential further questions, we have 2 more webinars coming up in December. The details are on our website. If you have any further questions you'd like us to follow up with, will the please email, if you have any further questions, please email info@ceri.ca. And if you look at, there's another question, will the PowerPoint presentation be available to participants? Yes. If you look at your options on your screen under handouts, you should be able to download the file that's there. It should say CERI, the Future of Oil and Gas webinar, November 19th. If you have any trouble working with that, then you can always let us know at info@ceri.ca. And we'll email you the copy if you're having any issues. The audio will be available. What's the details for the audio? We'll email you the audio as well as the presentation if you'd like it, and you can use it for your own work. And we're also available to have additional discussions with people and their colleagues and clients on this and many other issues that we've dealt with. Interesting that we have a question here from Richard Dunn. Interesting that go forward capital investments in natural gas isn't all that different than oil going forward. Thoughts with respect to raising the profile of natural gas in Canada? Well, I know the Alberta government is very passionate about the natural gas industry in Canada, in particular in Alberta, and they've got a section of their Alberta Energy that's devoted to increasing the profile of natural gas. Aside from that, it's only going to really happen, this higher profile, with the establishment of several LNG projects. Now we still have a number of projects on the West Coast that are being considered. We have some projects on the East Coast that are being considered. There's, I think, 3 right now on the East Coast, 1 in Quebec, 2 in Nova Scotia. So there's still a lot of interest in natural gas. And because Canada is competitive and will continue to be competitive in this area, my expectation is that we will see a lot more LNG capacity to serve Canada's market. And then that will allow Canada to raise the profile, not just in Canada, but elsewhere. So with that, I think we're going to close the session. Oh, sorry, thanks. Does your natural gas investment profile include the 5 BCF? Yes, it does. It does include the 5 BCF a day of LNG. And again, that's just a pure assumption. We know we've got some coming online with LNG Canada and the wood fiber plant, but that's not the full 5 BCF a day. We would need 2 or 3 others to fulfill that assumption. Okay, well, thank you very much, everyone. And as I said, you can download the presentation, and we'll be sending you the audio. And if you have any further questions, you can contact us at info@ceri.ca. Thanks again.